What's up, everybody? Today's episode is for anyone who is thinking about getting into real estate investing. This is anyone who is already flipping houses and honestly, anyone who owns real estate and wants to understand how this game really works over the long term. This is not a hype episode. This is not a get rich quick episode. This is an episode all about experience. It's my experience. Over the years, through owning and operating a real estate investment company and being involved in hundreds of transactions, there are a few lessons that stand out above everything else. These are not things you learn from books. These are not things you learn from podcasts by themselves. These are lessons you learn by being in deals, by making mistakes, and God only knows I've made my mistakes, and by writing checks you didn't expect you'd be writing. Today, I want to walk you through 4 fundamental lessons for real estate investing and house flipping. These lessons apply whether you're buying your first rental, flipping your first house, or scaling an entire portfolio. And I want you to listen to these not emotionally, but practically, because real estate rewards discipline, but not optimism. I'm Dustin Owen, and this is the DO Show. They don't teach this shit in school, but they should. I'm Dustin Owen, and for the past 20 years, the mortgage industry has been my classroom. I've helped over 2,000 families become homeowners, built a $1 billion mortgage operation from scratch, and earned my way into the top 1% of income earners worldwide. Along the way, I became a real estate investor, a business owner, and have invested in over 20 tech startups, even hitting a 20x return on one of my investments. This isn't theory, it's experience. Welcome to the DO Show, where I teach the lessons life taught me the hard way. Okay, so check this out. The first fundamental lesson is this: you make your money when you buy, not when you sell. This was the first lesson that I had to wrap my head around. This phrase gets repeated constantly in real estate circles, but most people don't actually understand what it means. People hear it and they think it means buying cheap, and that's not really the truth. What it really means is that the outcome of your deal is largely determined the moment you go under contract. By the time you're selling, most of the risk has already been locked in. When you buy correctly, a lot of problems don't matter. When you buy incorrectly, no matter how much creativity you have, it can't save you. This is where most new investors get themselves in trouble. They fall in love with the property, they fall in love with the layout, they fall in love with the vision, and then they start justifying the numbers instead of letting the numbers guide the decision. Experienced investors do the opposite. They let the numbers kill deals quickly. When you buy a property, you should already know how the deal ends. You should know your exit strategy before you even sign the contract. Are you going to flip it? Are you going to rent it? Are you thinking about holding this thing long-term? Or is it more of a short-term investment? If you don't know the exit before you enter the deal, then you're guessing. And guessing in real estate can become extremely expensive. Making your money when you buy means that even if things go wrong, the deal still works. Renovations are going to run over budget. Timelines are going to be stretched out. Markets will soften. Those things happen in real life. I know it because I've lived it, especially over the past 3 years. Buying right gives you room to survive those mistakes. Buying wrong, well, it only magnifies them. This is especially important in house flipping. Flipping is not forgiving. And some will tell you flipping is a sucker's game. There is no margin for emotion in flipping. Every dollar you overpay on the purchase price comes directly out of your profit. Every day the project runs long and your holding costs go up, it costs you money. Every surprise repair eats into your profit. And surprises? Let me tell you all about surprises. They are not rare. They are normal. This means your deal has to be strong enough to absorb them. That strength comes from buying right. The second fundamental lesson is this: margin is everything. Margin is what protects you when reality doesn't match your spreadsheet. Most people underestimate how important margin is because they have not been through enough deals to feel pain. Margin is what keeps a deal from becoming stressful. Margin is what keeps a deal from becoming emotional. Margin is what keeps a deal from becoming catastrophic. When you have margin, problems are annoying, sure. When you don't, problems are dangerous. New investors often structure deals that only work if everything goes perfectly. Perfect renovation costs, perfect timelines, perfect resale value. Y'all, listen to me when I tell you, that is not investing. That's gambling. Experienced investors assume things will go wrong. They plan for overruns. They plan for delays. They plan for softening markets. Margin allows you to stay rational when things don't go according to plan. Without margin, you panic. And panic is where bad decisions are made. Margin also gives you options. If the market shifts, margin gives you the ability to pivot. You can rent instead of sell. You can refinance instead of list. You can wait instead of forcing a sale. Without margin, you're stuck. And being stuck in real estate, like I've said, is very expensive. It's also very stressful. The third fundamental lesson is this: debt amplifies outcomes. Debt is not inherently good or bad. Debt is a tool, and when used correctly, it accelerates growth. If used incorrectly, it magnifies mistakes. Most people focus only on interest rates. That is a mistake. What matters more than rate is structure. How flexible is the debt? What happens if timelines change? What happens if income fluctuates? Good debt gives you room to breathe. Bad debt, well, it suffocates you. In real estate investing, leverage works both ways. When deals are strong, leverage accelerates profit. When deals are weak, leverage accelerates loss. That's why understanding debt is one of the most important skills an investor can develop. Not just how to get approved, but how the debt behaves under stress. If your deal only works because of cheap money, it's fragile. If your deal works because the numbers make sense, debt becomes a tool instead of a threat. This lesson applies heavily to those looking to flip houses. Short-term debt is unforgiving. Hard money, private money, short-term loans, they all require precision. Every month matters. Every delay matters. If you underestimate timelines or overestimate resale, debt will expose you quickly. That's why experienced flippers are obsessed about timelines and budgets. They understand that debt is always ticking. The fourth fundamental lesson, well, it's this right here. Risk is always present. You don't eliminate it, you manage it. Or my favorite word, you mitigate it. Many new investors try to eliminate risk entirely, and that's impossible. Real estate always has risk. Markets change, tenants move, costs increase, regulations shift. The goal is not zero risk. The goal is controlled risk. Controlled risk comes from understanding what you can control and what you cannot. You cannot control the market. You cannot control interest rates. You cannot control buyer behavior. You can control what you pay. You can control your structure. You can control your margin. That's where experienced investors focus their energy. They focus it on the things they can control. House flippers learn this lesson quickly. The house will reveal problems you didn't see. The inspection will miss something. The renovation will uncover surprises. And oh yes, surprises, and sometimes surprises within the surprise. Risk management is not pretending those things won't happen. Risk management is assuming they will. When you plan for risk, it stops being scary. When you ignore it, well, that's when things become overwhelming. One of the biggest mistakes investors make is assuming appreciation will save a bad deal. And that is not always the case. Appreciation is a bonus, but it's definitely not a strategy. If your deal only works because prices go up, it's not a deal. Strong deals work without appreciation. If appreciation happens, it's upside. If it doesn't, you're still protected. Another lesson that ties all four fundamentals together is patience. Real estate rewards patience more than speed. Bad deals often come from urgency, feeling rushed, feeling behind, feeling like you're missing out. Experienced investors are comfortable walking away. They know another deal will come. Desperation leads to bad buys. FYI, hint, hint, wink, wink, nod, nod. Don't be desperate. Discipline leads to longevity. At the end of the day, real estate investing is not complicated. It's not easy, but it sure as heck is not complicated. Buy right, protect your margin, use debt wisely, and manage risk with intentionality. Most people fail in real estate not because they lack opportunity, but because they ignore fundamentals. They chase upside instead of structure. If you're watching this as a consumer or an aspiring investor, here's the takeaway. Slow down. Ask better questions, understand the numbers, and respect the risk. Real estate can be one of the most powerful wealth building tools available, but only if you treat it like a business. And if you're already investing or flipping houses, use this episode as a check-in. Are you buying with margin? Are you relying on appreciation? Are you managing debt? Or is debt managing you? Those answers matter more than your next deal. That's what the DO show is all about. Real conversations, real experience, real lessons learned many times the hard way. If you want to continue learning, connect with professionals who have actually operated in this space, not just talked about it. Use the link in the description to get connected with experienced real estate professionals who can help you make better decisions. I'm Dustin Owen, and this was the DO Show. If you like content like this, make sure you click that subscribe button so you'll be alerted every time we drop new content.